Hello and welcome to this Mirror Facebook Live, all about what's going on with mortgages and savings after a week of financial turmoil. I'm Sam Barker, a money reporter here at the Mirror, and I'm very grateful to be joined today by Graham Hiscott, the Mirror's head of business. Hello, Graham.
Hello, good afternoon, everyone. Hello.
So this week, you can't have avoided it. There's been a series of worrying news stories all about the economy. One day it's the pound falling, then it's 40% of mortgages being pulled from sale, pension schemes at risk, topped off with today home loan offers actually being withdrawn. So we're going to be breaking all of this down for you today, including what's going on, what it all means for your money, and what might happen next. But we're also here to answer some of your questions. So if you have anything you would like to ask us, or you'd just like to have your opinion on the subject heard, please do feel free to post in the chat. We are monitoring that and we'll do our best to answer you both during the session and hopefully towards the end if we have time. So Graham, if we can kick things off, would you mind talking us through the turmoil in the mortgage market at the moment, perhaps starting with first-time buyers?
Yeah, well, it's certainly, it's rippled throughout, hasn't it, throughout the mortgage market. It's all basically down to the rates, the mortgage rates that first-time buyers, but across the market are now facing, as well as the availability, which Sam, you touched on at the beginning. This has all been caused by it's a ripple effect, basically, from the falling pound, and then which slumped even further against the dollar after last week's mini budget. Why did that happen? Well, that's because when the Chancellor Kwasi Kwarteng stood up and delivered his speech about cutting taxes, the biggest tax cuts in 50 years, he didn't flesh out exactly how they were going to be funded, and there was no sort of independent oversight of that, which we'd normally have on a big event like that. So what that did is basically to send things called UK gilts, which are another word for UK government bonds. What are bonds? They're an IOU that the government basically uses to borrow money to fund all of its activities. And the cut across, I'm getting to the point about mortgages because it is quite complicated. But anyway, the point is that those rising bond rates have an effect on mortgages, have a cut across to mortgages, and that's basically what we've seen. We've seen a big increase in those mortgage rates, and as you say, about 40%, I think, of all the mortgages that were available on Friday have now disappeared, and that is having a big effect on first-time buyers as well as everyone else. That it ought to be pointed out that there was some help announced in the mini budget for first-time buyers with the stamp duty cut, but that's been largely forgotten, I think, now because those first-time buyers, if they were getting a benefit from that, are now being hammered through the mortgage rates that they're now being asked to pay when they take out a new mortgage.
This is it, and I think very sadly as well, one of the first kind of casualties when mortgage lenders get very nervous, one of the first kind of casualties is people that are a little bit, maybe their circumstances are a little bit different. They're not what mortgage lenders like to call vanilla customers. So perhaps they're people with a little bit of adverse credit in their past, or they've maybe been made bankrupt. There are, in normal times, mortgages available for these people, but they're what lenders would see as a little bit risky. And when lenders get cold feet, as they are at the moment, these are often the very first mortgages to get pulled. So not only lenders, as Graham says, they're pulling mortgages from sale. 40% of mortgages on the market have now been withdrawn, but they're sort of tweaking the prices on the ones that are left. And so, Graham, if we're talking about people who perhaps, they're not a first-time buyer, they're on the housing ladder, they've got their own home and they've got their own mortgage, does the same kind of thing apply to them?
Well, yeah, I think that's a good point, Sam. We can get kind of caught up in the idea that everyone's impacted by this. But I think the latest statistics, Sam, you'll put me right if this is not correct, but about 83% of all mortgage borrowers are on fixed rate mortgages. Obviously, those with a mortgage are also obviously a subset of all the people in the country, because actually, I think, again, you'll put me right, I think the majority of people actually don't have a mortgage, or could be wrong there. But anyway, lots of people have obviously paid them off if they're lucky enough, or are renting, or other things, or other situations like that might be housing association accommodation. Anyway, so we're really talking about those well, it's still about 2 million or so who are affected immediately by these who are on variable rate mortgages and are affected but when rates jump up as they are. But, and this is a big but, it's also affecting hundreds of thousands of people who are coming off of these fixed rate deals, and they are really being hit hard because they may have fixed a couple of years ago, maybe even 5 years ago, at what were really low rates. And they are seeing their repayments go through the roof. So they're being hit very hard. In fact, they're probably seeing the biggest bill shock of all.
I'm with you, and it's it's a very sad thing to sort of have to witness as journalists as we are. So we just, if you just join us, thank you very much for tuning in. We're here to talk you through some of the big financial headlines of this week and how that really affects you and your money. This is an interactive session, so if there's anything you'd like to ask us, please do feel free to ask away. We're kind of monitoring this as we go through, and we can tackle any questions that you've got. So Graham, obviously there's a lot of people, they're looking at mortgage rates right now, and what they're probably thinking is, well, what about next year? Do we know what might be happening with the direction of mortgage rates? Are they going to keep going up?
Short answer, Sam, is yes. Sadly, there has been a pause in we had fewer mortgages pulled overnight actually than we did the night before, so there's been a little bit of a breather there. But certainly everyone I'm talking to, Sam, I think you're probably hearing exactly the same, is that yes, mortgage rates are certainly going to keep on going up, and that's partly because these the bond rates that I touched on earlier are going up, continuing to creep back up again today. But the other big factor is interest rates from the Bank of England. The Bank of England, remember, put up its base rate, or its bank rate, essentially its interest rate by half a percentage point last Thursday. It seems so long ago when I was sat in the Bank of England and I was talking to the officials there about why it gone up by, why they had to put up by that much. Less than a week on now, and there's lots of speculation that the bank might increase its rate by, well, there's been talk about 75 basis points, or even a whole percentage point. That said, the Bank of England has tried to calm those expectations, but it certainly said, one of its officials the other day, chief economist, in fact, talked about there being a significant rate rise to come. The next meeting of the bank's monetary policy committee, now it's the committee that basically sets these rates, isn't until the very start of November. So it could be that the next rate rise won't be till then. But to answer your question, Sam, yes, rates are definitely going to, sadly, I feel, going to keep on going up. Where they peak, certainly that's the big debate at the moment. There was talk of them peaking at something like 6%. Now, those that are listening into this, well, if they're of a certain age, they'll probably remember that the rates were considerably higher than that in I think the 90s, actually early 90s. But nevertheless, for a lot of people, these record low rates is the only thing they remember. So this is why it's going to come as a big shock. Whether they will peak at 6% is a different matter, and we'll have to see how things pan out.
Indeed, we will. Thank you very much, Graham. And just turning to the comments very quickly, we've got a comment here from Graham Searcher. Thank you very much, Graham. Graham says you have lots of people who have rent to buy mortgages. The rate increase won't cover the payments, and they're going to have to put rents up. I think that's very likely. For anyone who doesn't know, so rent to buy, it's a sort of government-backed scheme, and the idea is that it will it lets you kind of rent a house at 20% below kind of the market rent in that area. It helps you kind of save for a deposit and then go on and kind of buy a property. They're a little bit, you don't, in my mind, criminally, you don't see them talked about an awful lot. They're not written about an awful lot, but there are an awful lot of people who have got them. And I think it's very sadly, Graham, you are probably right. They are going to be people with these mortgages, I assume, such as yourself, are going to be feeling some pain on that, I'm afraid. Question here.
I was going to say that. I mean, that's the other knock-on effect of that is actually, will rents increase as a result? I mean, we sort of not really talked about renters, but those tenants, will they, with the landlords, because if their borrowing costs go up, will they pass that on in a form of higher rents? It's obviously comes down to the individual landlords and their circumstances, but that's certainly an upward pressure on rents, I would say, as well.
Yeah, I think that's pretty. Obviously, there'll be an awful lot of renters kind of tuned into this. If your landlord has a buy-to-let mortgage, then to a certain extent their hands are pretty tied by the mortgage lender, and they're going to be facing severe increases in how much they're paying for that mortgage. Unless they're extremely charitable, you would imagine that increase is going to be passed on to the renters in the form of kind of rent increases. Groups such as Generation Rent and Acorn, for example, they're quite clear that rents are increasing across the country anyway, and even if your landlord happens to own their own house outright and they're not in the pocket of a mortgage lender, obviously we're still in the middle of a cost of living crisis, and a lot of landlords kind of feel the need to pass on these rent increases anyway. So we've got a sort of a question here from Michelle Tomlinson. So Michelle, thank you very much. Michelle says, I'm 60. I've not taken my workplace. I think what you're saying is you're not taking your workplace pension yet. Should I? So we're probably not the best people to ask about this. We're not financial advisors. When it comes to taking your pension, that is a big decision, and it is well worth getting advice. There is actually free government pension advice available through an organisation called Nest, N-E-S-T, which is well worth looking up. What I would say is that if what you're worried about is all of these headlines about pension funds being in trouble, I would, and therefore, should I take my pension out because the pension fund's in trouble? I would probably say don't worry too much at the moment, but keep monitoring the situation. So the reason being, your pension will be protected. Anyway, thanks to the Financial Services Compensation Scheme, 100% of your pension is protected, even if the pension provider fails. And the Bank of England has taken quite a lot of action this week to make sure that pension providers will not fail. And that's something which we're going to be getting into later in this call. And just very quickly touch on a question here from Tony Wood. So Tony asks, where do you see the savings interest rates going? Tony, really great question. It's very, very pertinent, and we are going to come on to that. We're going to have a little section of this call where we sort of talk about savings interest rates, and we can talk a little bit more about some of the other points in your question there. So let's also talk a little bit about house prices. We were talking about property before we move on to some of the other bits we want to get into. Let's just talk a little bit about the future of house prices. So housing experts think that property prices in the UK are likely to fall by at least 10% next year, possibly going up to 15%. There are some people who say we may be looking at a much smaller fall, maybe 5 or 6%. But this is all because demand for property is expected to fall, and as demand falls, the theory is that prices will go down. And the reason for this is quite simple. It's what we've kind of gotten into earlier on this call. The reason is money. Mortgages are getting more expensive, and therefore there will be fewer people who are able to afford property, is the theory. Therefore fewer people buy it, therefore prices come down, is the kind of simple version. So some people might be looking at this going, oh, well, this is great news. I'm looking to get on the ladder. I can't afford to buy perhaps the ideal house because house prices are historically quite high. But if house prices fall, especially if they fall that fast, it's not really good news. So at some point, house prices would have to sort of dip down. That's the normal cycle of the market, up, down. But almost all people are going to need a mortgage in order to buy a house. And as Graham says, mortgages are getting much more expensive than they were, and will get a little bit more expensive, we think. Wages aren't also really going up enough either. And not only that, but in uncertain times like this, mortgage lenders, they have a tendency to sort of panic and pull deals. If you're already a homeowner, falling house prices is also potentially bad news because it raises the prospect of negative equity. Now, a lot of people on this call will remember the last time that we had negative equity, but because we've not had it for 30 years, I think 20, 30 years, most people, it's kind of fallen out of the popular imagination a little bit. But in short, it's when your house is worth less than the mortgage you're paying on it, which can put people in a very difficult financial situation, and often means that they're locked into their property as well. So just sort of moving on, I said, we wanted to come on to talking about, what is the Bank of England doing to help with some of this? Graham, what was the big news from the Bank of England this week, please?
Well, certainly, the big news from yesterday, which took most people, everyone, I think, by surprise, was something that's actually quite complicated, but in its simple terms, as you talked about, Sam, there was a real risk to pension funds. I mean, what would happen is that basically pension funds suddenly that there were a certain group of creditors that they had, and it was basically what they had is that because those creditors were spooked by what was happening with interest rates on these government bonds, suddenly said to these pension funds, right, we want our money, we want our money fast, we want it back now. And that caused it could have caused all the pension funds to start selling a lot of these bonds, a lot of these IOUs in a hurry, and which could have had a really big ripple effect throughout the whole financial system. I mean, having covered it yesterday, it only emerged later quite how serious it was, because it emerged that if the Bank of England hadn't stepped in, then there could have been a large number of pension funds that would have been technically insolvent, meaning that the value of their assets would be worth less than their debts. So the real fear was from the Bank of England was that if it didn't step in, and I'll mention what they're doing, then, as I say, that you could have had a whole load of pension funds that were technically insolvent. Now, that's not the same as saying that they would all collapse and everything. There would be calamity, partly because of what you mentioned, Sam, about the pension protection fund, the system in place. But it's certainly, the fear was that it would have created this contagion throughout the financial system. And now, if that feels slightly familiar for those with a long enough memory, then the same sort of thing, with a completely different starting point. If you think back to 2008 and the financial crisis, that was a whole different set of circumstances, but there was a contagion effect there. So what the Bank of England has done is it's basically said, right, well, we'll go out and buy those bonds. Any bonds that these pension funds want to sell, we'll buy them up to try and calm the market for the next couple of weeks. That's the initial period that they've announced. Now, whether the crisis is over in this particular part of the market, well, potentially, is the wider sort of financial chaos that we're seeing over at the moment. Well, that's certainly, I think we've got a bridge at the moment to what may come next. But certainly, that's what the Bank of England started doing yesterday.
Perfect. Well, thank you for taking us through that. As we sort of said earlier, there's definitely, it's just been one thing after another this week with with different big economic stories. Now, one thing we've not touched on really so far is savings. So Tony Wood obviously commented earlier. Tony, I said I was going to come back to you. We're now coming back to you. So to tackle Tony's first question, what's going to happen with savings interest rates? So if there is a silver lining to anything that's going on at the moment, it is savings rates. Obviously, we are in the middle of a cost of living crisis. Times are hard for many people, and for an awful lot of people, putting money aside as savings is simply impossible. But for those with cash stashed away, and actually government figures show that that is the majority of people, they do have some money in savings. Savings rates are on the up and up. So the best 1 year bond, which is a very popular savings option, is now 4.1%, and that's from Newcastle Building Society. And the top easy access account is 2.1%, and that's from a bank called Al Rayyan. Now, obviously, the big thing to mention here is that inflation is running very high. So inflation is far more than even the top rate that's available on savings deals at the moment. And what that means in real terms is that any money held in those deals, the value of it is being eaten away. One thing we always like saying on these Facebook Lives is that doesn't mean that you should lose heart, because if you do have spare money, you've got to keep it somewhere. Putting it in a savings deal is far better than leaving it under the mattress, or leaving it with your high street bank, who by and large, if you're leaving it in your current account, probably not earning very much interest, if anything at all. You've got to keep it somewhere, and you may as well keep it in an account which offers you the best return possible. The Bank of England does think, certainly up until this week, with everything that's been going on, the Bank of England was saying we will get inflation back down to around about 2%, which is their target, their usual target. That's normal for the Bank of England. We'll get inflation back down to 2% within, I think they said 2 years. I mean, Graham can correct me if I'm wrong on that. But so long as base rate stayed high, base rate is the Bank of England rate that's sort of built into mortgage deals, then it's quite good news for savers. And the future for base rate, it looks like it is going to have to increase, perhaps to, as Graham said earlier, maybe as high as 6% next year. So we could be in an environment next year where even an easy access account, which they don't tend to pay the most competitive rates, an easy access account may well pay 6 or 7%. We've not been in that environment for easily 10 years. I'm going to go ahead and say an awful long time. So Tony's also asked, are we going to have to wait for the next base rate increase? So yes, as far as I'm aware, we are, because I think I'm right in saying, Graham, that the Bank of England, they've ruled out an emergency base rate announcement.
They have, although quite frankly, what we were talking about that the bank did yesterday, which was going out and buying bonds. It was only on last Thursday that they said that they were going to start selling them. So things can change very quickly. But you're right, Sam. That's certainly that. Well, that's the message that they're sending out. That's what they want the financial markets to absorb and to try and price into to all the things that they set. But to answer Tony's question, that's the logic. But there's things that are happening at the moment that are taking everyone by surprise. But let's work on that assumption for the time being.
Perfect. And just to sort of tackle another point which Tony asks, Tony's asking, as pensioners, we're looking forward to a 10% increase in the state pension on the Peston programme. Robert Peston, obviously the journalist, the Chief Secretary to the Treasury, was suggesting the triple lock might be revoked. Opinions. So Tony's completely correct that we were looking at a very large increase to the state pension next year. So just as a sort of a little laying the groundwork for how this works, a political agreement called the triple lock means that every year the state pension will go up by one of three measures. It will go up by 2.5%. It will go up by the rate of earnings growth in September of the year before, or it will go up by the rate of inflation in September of the year before. Now, the only time that the triple lock has been suspended in its history was this current year, and it was due to come back online in 2023. Now, what it looked like, and it still looks like, because the government haven't said anything to contradict this, is that we will be putting up the state pension by the level of September inflation, because inflation is so high. I believe September inflation, 9.9, 10%. Some people thought it might even get up to 13. Now, obviously, last night, as Tony quite rightly says, government officials were sort of suggesting that they might water down the triple lock again. So when the triple lock got too expensive for the government to honour last year, they said, "Don't worry, guys, we're going to change it to what they called a double lock." So it still went up but not by as much as it might do. And yes, I mean, it does look like this kind of state pension increase that people might have been expecting, it could be snatched away, but they haven't finalised anything yet. So, as it stands, we're still due this, this big state pension increase. But you said, you want the opinion. I mean, my opinion is that they probably will water it down, but there's nothing official. It's just that my feeling is they've done it before. They could probably do it again. And yeah. Anyway, Graham, it sounds like you've got you might have something on that.
No, I tend to. I think what we're not hearing. Those listening to this have probably heard a lot about talk about the government's borrowing and how much it fears about it. We talked about it, about how much the government's going to have to borrow for all these promised tax cuts. What really hasn't been touched upon, and one of the things that has spooked the markets, is there's been no talk about the other thing which the government can do, which is spending cuts. that's going to be inevitable, but they've sort of largely ignored that. And that is, I think you're going to be hearing a lot more of that. There's already been rumblings today about big spending cuts for government departments in terms of their own internal departments. But I think you're right, Sam, that the things like big bills for things like the triple log, commitments like that are going to be, well, there's going to be a lot of scrutiny of that. And as you say, because they've already broke their promise, remember that it was their manifesto pledge in this last financial year. I'm not saying it's going to happen, because I hope for everyone who's banking on that 10% increase, I hope it goes ahead for your sake. But I think the next few weeks we could be hearing something, perhaps at this next fiscal event, which is not scheduled for the end of November, isn't it, Sam? But anyway, I think there's going to be a lot of talk about whether that can be funded, and not just the state pension, other benefit uplifts as well. It's going to be a lot of focus on basically where the government is going to be having to look at spending cuts.
Yeah, and especially for things like universal credit, where there are millions of people who kind of claim it's the single biggest benefit after the state pension. I mean, it is very, very interesting to see what the government are going to do with these kind of state benefits. We've got a quick question here from Diana. Now, I do hope I get your surname pronunciation correctly, Diana. So Diana Derengowski. Thank you for this, Diana. She says, what are they going to do for the pensioners to help with the cost of our heating and electric and the cost of the extra food rise? So I think this is a good point to kind of get into some of the financial help which is coming down the pipeline for pensioners. So the most sort of specific thing, the thing that people who are pensioners will get, which no other group gets, is something called the pensioner cost of living payment. So the former Chancellor, Rishi Sunak, he announced this earlier in the year. It's not been paid out yet. So it's being paid out in November and December, and it's worth up to £300. In order to get it, you need to be eligible for the existing winter fuel payment, which predates the current government, and that's worth anything between £100 and £300 a year, and it goes out to qualifying people above the state pension age. If you the other kind of help which I think would apply to you, Diana, is that there is a £400 discount to energy bills coming, which if you have a meter in your property and you're responsible for that meter, you will be getting, you should start getting it from next month's energy bills. It will vary. How you get the money varies a little bit depending on who your energy supplier is and what kind of meter you've got. But for most people, that will take the form of a discount on their energy bills every month of around about £66 until the £400 has been totally removed. And the other thing, and this is something the government kind of treat this as a kind of a catch-all option for people who are struggling, is something called the Household Support Fund. So this is a pot of money, more than £1 billion, which the government have given out to local councils. The local councils then have to hand that out to people in their areas. So it's one of the only pots of money available from the government where you have to apply for it, because all of the rest, if you're eligible, you'll get it, bar a few cases which fall through the cracks. So you have to contact your local council. They will ask you to prove that you deserve that money. We've seen cases of up to £300 being paid out to families through the Household Support Fund, but you can only claim it once. So it's well worth investigating. And the same thing goes to anybody on this call. You don't have to be a pensioner to get it. It's open to absolutely everybody. The main criteria is that you are facing real hardship. And what you'll get from the Household Support Fund could be money, or it could be vouchers, for example, to spend in a supermarket. So thank you, Diana, very much for your question. Now, I think that sadly we might be coming to the end of this session. We've already sort of slightly overrun. I wanted to say, thank you everybody for tuning in. Thank you for all your questions. I hope that you found that helpful. Huge thanks also to Graham Hiscott for giving up some of his time to break down some of this very complicated subject for us. Thank you, Graham. And we're going to be back next Thursday at 1 p.m. with another cost of living Facebook Live. I hope to see you all there.